The corporate laws in India got revolutionized by the Companies Act 2013 with the introduction of various new concepts that were non existent previously, such as the introduction of the concept of one person company, which was one of the game changers. A whole new way of starting businesses was recognized, which granted flexibility that an entity like a company could offer. Hey guys, welcome back to our channel Knowledge World. In this video, we will be learning about different business entities in India. There's a difference between business entities and a company. A company is a type of a business entity. So there are mainly three types of business entities: companies, firms slash partnerships, and individuals. Under companies, we have one person company, public limited company, and private limited company. Under partnerships, we have limited liability partnership and a partnership firm. And under individuals, we have sole proprietorship. There are even other entities such as non-profit organizations like NGOs and cooperative societies and even religious trusts. In this video, we'll be learning about types of companies, that is public limited, private limited and one person companies. And in the next videos, we'll be covering partnership firms and sole proprietorships. So now let us understand about one person company. So what is a one person company? One person company by definition is a company which has only one shareholder as its member. An OPC means a company formed with only one person as a member, unlike the traditional method of two members. One person company has showed path for small traders and service providers to enter into the business world by expanding their opportunities through corporate identity. A one person company enjoys the benefits as the corporate enjoys. Aside to this, it also has some relaxations in provision of company law. Let us discuss the features of OPC. First one, limited liability. Since it is a company, the owner and the company are treated as separate legal entities, and the liability of the owner or the shareholder is limited to the amount invested in the firm, and his personal assets will not be touched. Since one person company provides a legal status and social recognition for a business, it gives suppliers and customers a confidence and a sense of security. Even though there is only one member, one person company follows the principle of perpetual succession, that is, business keeps going on. On the death slash disability of the owner, the company can be succeeded by a nominee who is appointed by the owner during the formation of the company. Easy to obtain funds. Since one person company is a private company, it is easy to go for fundraising through venture capitals, angel investors, etc. The banks and financial institutions prefer to grant loans to a company rather than a proprietorship firm. Thus, it becomes easy to obtain funds. Less compliances. The Companies Act 2013 provides certain exemptions to the one person company with relation to compliances. A one person company need not prepare the cash flow statement. The company secretary need not sign the books of accounts and annual returns and be signed only by the director. Quick decisions. Since it is only one person managing the affairs of the business, the decision making process is quick. These were the benefits or the features of one person company. Now let us discuss the limitations of one person company. Suitable only for small businesses. The maximum number of members the OPC can have is only one at all times. Since more number of members or shareholders cannot be added to the company to raise further capital, it becomes difficult with the expansion and growth of the business. Restriction of business activities. A one person company cannot carry out non banking financial investment activities, that is, it cannot invest in other companies, including the investments and securities of any other corporate bodies. So, this means a one person company cannot invest in other companies' shares and securities. It cannot be converted into a company with charitable objects mentioned under the Section 8 of the Companies Act 2013. And since there can be only a maximum of one member in the company and we cannot attract investors to buy the shares of the company is forced to take debts. And since the company cannot give shares to any other members, a one person company cannot offer ESOP to its employees as well as shares. If the company's paid up capital exceeds 50 lakhs and the revenue surpasses 2 crores, the company has to convert either into a private limited company or a public limited company. So these were the limitations of a one person company. If we talk about the tax applicability of OPCs, an OPC would have to pay a flat 30% tax on all profits and there are no exemptions. Now let's move on to private limited company. As the name suggests, it is a privately held company with limited liability and separate legal entity and is regulated under the Companies Act 2013. By definition, a private limited company is a distinct legal person with limited liability, that is privately held, and it does not offer its shares for free transfer to the general public. In case of a private limited company, the firm alone is responsible for all business losses and obligations, and shareholders may not be held liable for debts acquired by the company. So, if we talk about the features and benefits of a private limited company, there should be a minimum of 2 directors and 2 shareholders to form a private limited company. The director and the shareholder can be the same person, or the shareholder can hire a professional as the director for running the business. There can be a maximum of 200 members and a maximum of 15 directors in the company. Limited liability. Similar to OPC, a private limited company enjoys separate legal entity, that is, the owner and the company are different entities, and the liability of the owner is limited to the amount invested by him in the firm. Seek loans and attract investors. Since private limited companies are highly regulated with strict norms by the government, they enjoy greater trust from investors and can also issue loans from the financial institutions much easily compared to OPCs or partnerships. Foreign investment. Not only do they enjoy greater trust of foreign investors and receive foreign investment, a private limited company can also have a foreign businessman as a board of director until there is at least one director who resides in India. So these were the benefits and few features of a private limited company. If we talk about the disadvantages of a private limited company, registration and setup cost. The setting up cost is much more complicated and expensive when compared to a OPC due to various legal and administrative costs, documents and procedures, etc. Transfer of ownership. The transfer of ownership is very restricted in a private limited company, which makes it difficult to transfer shares from one person to another. Compliance formalities. There are a lot of compliances to be followed by a private limited company, such as income tax returns, GST returns, TDS returns, labor laws, and many other MCA norms are to be filed every year. Next is all the financial statements and documents such as MOA, etc. of a private limited company can be obtained by anyone from the MCA website by paying a nominal fees. Double tax. Taxes are paid by company on their income through the income tax and other corporate taxes, and even shareholders pay tax on their income, resulting in double taxation. So these were the disadvantages of a private limited company. Now if we talk about the taxation for a private limited company, if the turnover crosses 400 crores, tax rate will be 30% on income, and if the turnover of a private limited company is below 400 crores, the tax rate will be 25% on income. Now, finally, let's talk about public limited company. A public limited company is a company that offers shares to the general public and has a limited liability. Its stock can be acquired by anyone, either privately through IPOs or via trades on the stock market. It is strictly regulated and is required to publish its true financial statements regularly to keep its shareholders aware about the financial condition of the business. If we talk about the features of a public limited company, it needs to have a minimum of 3 directors and 7 shareholders. There can be a maximum of 15 directors, but there is no limit on the number of shareholders in a public limited company. There can be unlimited number of shareholders since the shares are traded publicly in the stock market. Limited liability. Similar to one person company and private limited company, a public limited company enjoys limited liability and separate legal entity. And a public limited company is required to have a minimum paid up capital of 5 lakhs. So these were the features of a public limited company. The advantages of a public limited company are more capital, since shares are also offered to general public at large, that is, anyone can invest in the company. It becomes easy to raise huge capital, not just general public, it also becomes easy to attract big investors. Growth and expansion. There is a perfect opportunity for growing and expanding the business by investing in new projects from the money raised through the shares. Popularity. A public company gets more news coverage and brand promotion compared to OPCs and private limited companies, which increases the brand awareness of the business. Listing on the stock market also increases the reputation and prestige of the business, which helps gain the trust of investors and other financial institutions. If we talk about the disadvantages of public limited companies, more regulatory requirements. Public limited companies are subject to more regulations than private limited companies. These include disclosure of financial information, higher transparency. Since the company has to disclose all financial statements of the business, such as balance sheet, P&L, and cash flow statement, it may cause problems to the business in some situations. Dilution of control. In a private limited company, majority of the shares are owned by the owner, or even if it is divided among other partners, the people are usually known by the owners. In a one person company, all the shares are owned only by one person, so the control remains with the owner. But that's not the case in public limited company. Here, the shares are owned by everyone and anyone and cannot be controlled on who should hold the shares, as the shares are offered to the general public and anyone can buy it in the stock market. This not only dilutes the control of the owner, but also in some cases, the original owner of the business can lose control of the company. A public company must hold annual general meeting and is answerable to the shareholders about the company's performance. So these were a few disadvantages of a public limited company. If we talk about the taxation for a public limited company, it is the same as private limited company, where if the turnover crosses 400 crores, the tax rate will be applied 30% on income. and if it is below 400 crores, tax rate will be 25% on income. So finally, let's talk about who should opt for which type of company. If your business operations will be on a small scale, you do not want to file much compliances, want to have complete decision making power and enjoy limited liability, you can opt to set up a one-person company rather than going for a partnership. So who should opt for a private limited company? If your business has a potential to grow to a medium or large scale, includes a lot of risks and requires a lot of debt, raise capital externally via investors, there are high chances of loss, do not want complete transparency of financials, and want ownership to remain within you or the owners, in that case, you should opt for a private limited company. And finally, you should opt for a public limited company only if you want to raise huge capital for your business without raising debt, which can be only done by offering shares to the general public and increase the reputation and prestige of the business. In that case, you can convert your firm into a public limited company. But if you want a control to remain within yourself and do not want to dilute your control, then going for a public limited, then opting for a public limited company will not be a good option. So viewers, that is it for this video. In this video, we learned about the different types of companies and their advantages and disadvantages. In the next video, we'll learn about partnerships and LLPs. Hope this video was informative. That is all for this video. Thanks for watching.